In short term rentals, control is the real competitive advantage. Control over your bookings, control over your guest experience, control over how your business grows in 2026. Lodgify gives rental operators the tools to build direct booking websites, automate guest communication, and manage every channel from one platform without adding complexity. This is how rentals stop feeling reactive and start feeling more intentional. Skip Daily Briefing listeners get 20% off any yearly or bi-yearly Lodgify plans with code SDB20, available through March 2026. Details are in the show notes.
Another day, another live from an airport. Today it's Las Vegas. It's Wednesday, March 18th. I'm Sarah Dandashi, and this is the Skift Daily Briefing. Today we're talking about where travelers are pivoting as the Middle East disruption continues, why Delta says demand is still strong even with fuel costs spiking, and Hyatt's very unglamorous but very strategic catch up plan in the U.S. Let's get into it. First up, the reroute story. As the Iran war continues, travelers booking ahead for Easter and beyond are actively pivoting away from the UAE and wider Middle East. And that demand is flowing into three lanes. Lane one is closer to home travel in Europe. Think short haul choices that feel easier to commit to right now. Germans, for example, are leaning towards Morocco and Greece. Italians are shifting towards places like Croatia, Spain, and other nearby options. And British travelers are gravitating towards Malta, Morocco, and Montenegro. Lane two is Asia holding strong: Japan, Thailand, Vietnam, Cambodia, and the Philippines. But there's a very real condition attached. This only works if direct air connectivity is there and airfare stays competitive at a time when fuel surcharges are doing what fuel surcharges do. And lane three is long haul. If I'm going big, I'm going big, with more interest in places like South Africa, the Maldives, and parts of Central and South America, including Peru and Brazil, which, by the way, is where I just was. The bottom line: confidence dropped in one region, but demand didn't disappear. It just redistributed. But here's the catch: airlines can't instantly throw planes at new hotspots. Schedules, crews, and aircrafts are planned months ahead. So even if travelers are ready to pivot on a Tuesday, capacity doesn't pivot that fast. If seats don't appear, prices rise. And when prices rise, staycations start looking, well, surprisingly attractive. The takeaway here is that the traveler can change plans quickly, but the aviation system really can't. Our second story today: Delta is basically saying, yes, fuel is ugly, but demand is still winning. Delta CEO Ed Bastian said that the airline has seized some of the highest sales day in its history over the last month, with sales up about 25% year over year. And he's not describing strength in one corner of the business. He's calling out corporate, international, premium leisure, main cabin, and domestic. In other words, the demand picture is broad. He did note Europe point of sale has dipped somewhat in the first quarter since the Iran war broke out, and framed that as expected when there's a war in your backyard. But the headline is that Delta expects to increase its first quarter guidance because demand is coming in stronger than forecasted. Jet fuel spot prices are hovering around $3.75 a gallon, more than 50% higher than last year. And Delta has suggested that that could mean $400 million hit in the quarter. And yet, premium demand is helping offset the pain. So here's the key point: the higher end traveler is still traveling, and that resilience is underwriting a lot of airline optimism right now. And our third topic today: Hyatt, and a strategy that's not glamorous, but is absolutely a growth engine. Hyatt is trying to fill in the blank spots on the US map, small and mid sized cities where it's historically had little or really no presence, by leaning hard into select service, extended stay, and conversion friendly brands. The company just announced the pipeline of more than 30 hotels in the southeastern US, roughly 4,000 rooms, anchored by three brands: Hyatt Studios, Hyatt Select, and Unscripted by Hyatt. This is catch up math, basically. Hyatt has said that it averages about four hotels in markets where it has a presence, while its biggest competitors average closer to 14. Marriott and Hilton have been building secondary markets for years, and they've been adding their own extended stay flags because population migration, remote work patterns, and corporate relocations have boosted demand in these smaller markets. So it's net net. Hyatt is buying relevance where it previously left holes, and it's doing it with brands that are cheaper to build, faster to open, and easier to scale through franchising. All right, well, that's it for your Skiff Daily Briefing live from Las Vegas Airport. If there's one theme today, it's adaptation. Travelers are rerouting, airlines are leaning on premium demand, and hotel groups are racing to plug coverage gaps while the market is still moving. For more travel industry news and analysis, as always, head to skift.com and be sure to subscribe at skift.com/daily. Thanks so much for listening.